Warning, the life insurance industry is splitting into two, and I don't want you to get left behind and caught in the middle. In this video, I'm going to break down whole life versus IUL, which one is the best one, finally, once and for all. So a lot of people have been reaching out to me, and I'm really excited to do this video. I apologize, I'm getting over COVID, but I still want to make sure I'm producing something that I can really bring value to my audience with. And a lot of people have been asking me, Daniel, what is better, whole life or IUL? I talked to one agent, and they say, I gotta go with whole life. Talk to another agent, and they say, no, it's gotta be an IUL. And there's two camps that have really divided themselves in the life insurance industry. And I'm somebody who's used both. So I've kind of emerged as somebody to a lot of people, or people reaching out to me saying, hey,
you kind of seem to have this middle of the road point of view where you don't really think one's bad or good. I'd like to learn more about that.
And I truly believe that. I'm just going to be upfront with you. There's no gotcha at the end of the video. I'm not going to come out and say whole life's the winner or IUL's the winner. I really truly believe it depends on your needs, your objectives, what you want to use it for. And I just think that overall in this video, my message could be one thing. It's that I think we need to kind of maybe lower the expectation on the sales presentations that people are seeing, because they can be juiced up to look really, really good. And we want to be realistic with how they're probably going to work and what they're going to look like and how you're going to use them. I think we should break down a few points that will really help bring some clarity to this, so you can make good decisions and not get caught in the middle and be in this tug of war between what's the right thing to do or not. So the first thing I think we should talk about is how they earn money. And I think that's important. I also think it's important just to overall give a quick disclaimer that you really buy life insurance for the death benefit. It's the reason you buy life insurance. You buy it and it has a benefit that will pay if you die. That's the basic function of it. Now, there's certain types of policies, IULs, whole life, there's also variable life, there's all kinds of different ways you could structure it. Universal life, guaranteed universal life, survivorship, universal life, there's survivorship, whole life. I mean, there's all kinds of different structures, but we're just gonna break it down and go IUL versus whole life for the purpose of this video. Now, whole life is going to earn a dividend that gets declared. The dividends are not guaranteed, but the company will provide a guaranteed amount of interest no matter what dividend they declare. Now, a lot of whole life agents will say, well, this company's been around for 100 years, they've always declared a dividend, and that's true for a lot of places. Sometimes they'll miss a dividend, but for the most part, they're gonna provide a dividend, which is basically just like a dividend. It's going to be a portion of the profit that they're able to give back to you as a policy owner. And this is why a lot of people encourage you to work with mutual companies if you're going to go with whole life, because the mutual companies are run for the benefit of their policy owners, not stockholders. So they're going to be incentivized to be potentially more favorable if you own a whole life insurance policy through a mutual company. So you're going to get dividends in whole life. In IUL, you're going to get potential index credits based on the performance of an index and the index choice that you select. So what they're going to do is they're going to look at maybe the S&P 500, maybe the Dow Jones, maybe the NASDAQ, maybe they'll have some proprietary indices with different banks like Barclays, for example. And you're going to get a participation rate or a cap. So basically they'll say, hey, you can participate in 90% of whatever the index earns, or they'll say, hey, you can participate in 16% of the upside potential of the S&P 500. Everything above that participation rate or cap is not yours. And if the market goes down during your index segment, you're not going to lose any money, but you're not going to make any money. That's typically what an IUL agent will instruct clients on, how they can expect their interest to be credited. So one offers a dividend that the company's going to declare every year. One is going to be whatever performance you can get out of your index during that segment based on your choice. Sometimes you can split it up between different index choices and try to get some diversification. Maybe you can get a couple in the NASDAQ or one in the S&P, and you can split it up that way. So really, the earnings are really based on the company for whole life, and the earnings are really up to you and what you choose, or you and your agent choose, for the IUL. Now, whole life is going to be generally what I would consider a little bit more rigid. It's not going to be something where you can maneuver around too much, but I do believe that whole life can be set up where you have more access to higher cash value earlier. IULs typically are going to have maybe that longer surrender charge period where you're going to be vesting your cash value, but they are going to be more flexible. So for example, if you have a year where the premium is tough to pay, an IUL is probably going to be a little bit more flexible and forgiving than the whole life policy, because the whole life policy is going to take a loan and pay the premium out of itself. The IUL can go a little while, potentially, depending on how your policy's set up. Now, if you're going to be using this to be able to access your cash value while you're building this death benefit up and building premiums in the policy, then you're going to want to have a paid up additions rider on your whole life policy. And the paid up additions, you're going to be able to put more money in the paid up additions, and that's going to give you access to more cash value in a faster way. With the IUL, you're going to want to overfund it. So for example, there's going to be like a minimum funding, a target funding you can shoot for, and you want to fund above that up to the limit that you can put in the policy without making a mech, so that way you can try to make sure that you're overcoming those fees and you're going to have more cash value, getting more potential index credits, so that way your policy can have the potential of the cash value increasing once it vests. So they're different. They have different mechanics. They're for different people. They're for different risk capacities. It's hard to understand them because they get stuck in really just being sold one way or another. And this is where the divide comes in, where I'm trying to help people. Because a lot of times people will go to one agent or another, and if they're a whole life agent, guess what? They're going to try to sell them whole life, and they're going to just downplay IUL. And same thing with the IUL agents. They're not even going to offer whole life. They're just going to say, hey, I think we should just go with this IUL. The truth is, you really need to understand both so you can make an informed decision. It's hard to understand both. They're complex products, and the illustrations don't help, because the illustrations that you're seeing typically, I found, are pretty worthless. You know, they're good for showing an example, but I don't think that they're ever that realistic, because it's making assumptions, and things change in the real world. Your policy is going to perform differently. Something's going to change. You're not going to get interest one year in an IUL. The company may not declare the level of dividend you were expecting for the whole life. You may skip a premium, and that could change things. You could take a loan, and that could change things. So, you know, people get married to these illustrations like they're gospel, like that's what's going to happen. And in fact, it's the opposite. They're very rarely ever going to happen. If you're looking at IUL versus whole life, I think that the key is to really understand why you're buying it and how you're going to use it. If you're buying it just for the death benefit alone, and you just want to try to get the best death benefit you can, well, I think both have a strong use case for that. I think you could use either policy pretty effectively to really just build a massive benefit, and both offer living benefits, which means that the death benefit can be paid to you while you're alive if you need money for a qualifying care event. So both of them are really powerful in that regard. Now, if you're going to try to use the cash value along the way, then I think you really want to figure out what company you're working with and what type of policy you have. With whole life, you got to be careful. You really want to go with mutual companies with something called non-direct recognition, which that's going to be that participating loan. So that's what's going to be why a lot of people use whole life, because they are sold it as, hey, you can take your money out and it'll still earn a dividend for the rest of your life compound while you're using it over here. And that can be the case if you set it up correctly. Now with IUL, you know, you're going to have options on how you can take loans. And this is where sometimes you can get into a really good situation or a really bad situation, because not every company gives you those participating loans right away. A lot of IUL companies only offer what's called a fixed or wash loan initially, which means that you're going to take the loan and they're just going to give you a fixed interest rate. Typically, it's going to be enough to cover the loan and maybe make a little bit. That's that positive arbitrage, the difference between what the company's going to credit you and what you're going to take out in loan interest. Now, another thing I want to clear up is there's no scenario where you're paying yourself back the interest. Doesn't matter if you go IUL or whole life, that interest is going to the company. Now, you're going to earn money on that loan that you have outstanding, and that's where you get some positive arbitrage, and that's where you may feel like, well, maybe I'm not paying that much interest since they're giving me the money to pay the interest, basically, or potentially give me the money to pay the interest if you choose an indexed or variable loan with an IUL. But sometimes people think that they're getting in a situation where they're going to be able to put all this money in a policy and then have access to it right away. You really want to be aware of how you're setting up your policy. So, for example, with an IUL, you're going to typically have pretty hefty surrender charges for the first 10 to 15 years. Now, you can have situations where you can get to a break-even point where your cash value that you could access is equivalent to what you put in. That's typically not going to be till later, maybe year 8, 9, 10. Depends on how your policy's set up. You can buy riders to give you early high cash value sooner, but those come with costs that can affect the policy down the road. Same thing with whole life. There's going to be this kind of teeter-totter relationship between how much money is going to, paid up additions, and how much money is going to, what they call the base premium. And so, you're going to have this balance between how much money is going to base versus how much money is going to PUA, and you want to have a good blend. If you want to have access to more cash value early, probably something like a 90-10 could be potentially better if you want to have that access sooner. But again, there's relationships to the dividends on the long-term performance of the policy, and so everything is like a teeter-totter with these policies. You can scale them up one way, but it is going to impact something over here, and you can scale them the other way, and then you might give up some liquidity. So you really want to be working with an agent that can help walk through different scenarios so you can see, oh, well, if I shift my ratio on my whole life policy to more money going to the base premium or less money going to the base premium, you can see different mechanics happening. With the IUL, you can have similar ways to structure those things as well based on how much you overfund it, how low they can make that death benefit. So you really want to find the sweet spot that's best for you, and you want to make sure you have a clear expectation on how you're going to use the policy. Now, a lot of my clients, and including myself, we have opportunities that are, far beyond the interest that a life insurance policy can earn in the first place. But, it's advantageous for us to use life insurance because you can have a situation where you can use your capital for something like an opportunity, and then you can have it building long term for your future where it's going to compound, and over time, you're going to build more cash value, you're going to build more benefits, you're going to have better dividends or potential higher index credits, and that's how you're going to be able to build something for your future, which I think is important. So I can't say that I'm married to one or the other. I'd say in the accumulation phase of my life, I'm going more whole life right now. In the distribution phase of my life, or the phase of my life where I would say maybe more in the distribution phase of my life, I'll be using IULs as modified endowment contracts. I really like those a lot. I think they offer a lot of value. I think they remove a lot of that front-loaded cost and time frame with an IUL. That doesn't mean I'm discouraging IUL. It just means for me personally, I like the way I can set up my whole life where I have much more liquidity, and I think that it's going to provide a lot of value with the dividends long term. And if you want more information, please feel free to reach out. I'm happy to help anybody to go through those and figure out what's right for you, and I can show you what I own as well, which I always love to do. So if you have any questions, comment those down below. Please like the video, share the video, and I just want to say thank you so much for watching. I'll see you in the next one.